Welcome to Condo Insider this week. My name is Jonathan Billings. I will be your host today, and we are discussing budget preparation during COVID-19, specifically for fiscal year 2021. Today, my guest on the show is Richard Emery. Richard is the Vice President of Associa and also the co-chair of Community Association Institute Legislative Action Committee. Today, we'll be giving a dive into operating budget preparation and reserve study review for your fiscal 2021 financials or budget preparation for your owners at your associations. And I'll just dive right into it. As everybody is aware, and Richard, you are probably aware of this, that the Department of Labor and Industrial Relations released an unemployment report just a number of days ago, saying that jobs have declined by 105,500 people over the year. July 2020, the unemployment rate was 13.1% versus a year ago, 2.7%. Obviously, these times are very challenging economically for many of our residents here at Hawaii. And I'd like to really dive into the operating budget side and how we could possibly lighten the financial burden for these homeowners. As you're well aware that an operating budget for associations are based on a zero-based budgeting method, and essentially the maintenance fees collected from the owners are sufficient to cover those expenses for that association. A budget generally has revenues and expenses. On the expense side, you have your mandatory spending and then your discretionary spending. Mandatory spending, you really can't do too much about. Those are forced expenses such as utilities, insurance, and there's really little leeway on how those expenditures play out, except for the based on usage and what those premium rates may come in at. But there's also the discretionary spending side where the associations of the board have a little bit more discretion on that decision-making process. Do you have any input or insight on how the board may look at the mandatory versus discretionary spending with their operating budgets?
Well, I've been doing this a long time. I remember a long time ago when I helped George Washington buy Mount Vernon. And so I've been in the industry a very long time and have a lot of opinions, on this subject. But I think the risks we have in front of us today are probably in several categories. Number one, what is the impact of this additional unemployment going to be on maintenance fees, delinquencies? In the sense, as you pointed out correctly so, that we're on a zero-based budget. So it depends on everybody, 100% of the owners paying their maintenance fees. And although historically we've always had some delinquencies, 5 to 10%, I would say maybe is the norm, without having data to back that up, but not really a lot. You get in a situation, are we going to see that go to 10 to 20 to 30%? And so if that happens, how is the association going to react within its budgeting and its financial resources to deal with it? So it's a little early to tell how bad the delinquencies are going to get. I haven't, in the first couple of months here, I haven't seen major changes as far as the delinquency levels. But how about you? Have you seen the major changes in delinquency levels?
No, I haven't seen any really major changes, fortunately, in the delinquency levels currently. Obviously, I think the CARES Act and the stimulus packages that are in place currently have been assisting that process or keeping those delinquencies low. That being said, there are still several people out of jobs, and we don't know whether Congress will continually passing those stimulus packages to subsidize these job losses. That being said, I have not seen an increase in delinquencies at this point, but it's very likely or possible that those delinquencies could rise during next fiscal year. And that being said, it's my opinion that the board may want to take an extra look at their 2021 operating budget and reserve study to possibly try and keep maintenance fees at the level they are, minimize the increase if absolute possible, or potentially even lower those maintenance fees for fiscal year 2021 in anticipation that these economic challenges will still continue into 2021.
Yeah, before I answer your original question about what they can do, I'll just make one more comment about this, is that a couple boards asked me about whether they should establish quote their own CARES program and go out to owners and say, we know if you can't pay your maintenance fees, come to us and we'll give you payment plans and we'll try to do what we can or reduce your payments temporarily. Whether I thought that was a good idea, and I told them I really didn't think it was a good idea. That they certainly want to encourage owners to come to them and communicate when they have a problem, but to, on a proactive basis, go out and offer a program when they have the zero-sum technology where they have to get enough money to pay their basic bills, didn't seem to me to be prudent. And what the problem and the stress right now for coming down the road is a lot of this additional unemployment benefits have lapsed. And even though our governor has said he's going to tag into some of the additional payments that the federal government's offered, it doesn't make up for what they've lost from the original round of extra $600. So it's going to be something the boards have to be very cognizant of and be very careful of in their budgeting. Otherwise, they're going to find they don't have cash to pay their bills, pay their employees, or whatever it may be.
So what are some ways that you may see that the boards could approach the budget differently in 2021 to make sure that they're staying on top of their absolute necessary bills?
Well, understand this, we're in an unusual situation. So what I'm advocating today as far as opportunities, I'm going to call them short opportunities because of the COVID crisis. These aren't techniques I would use regularly during the year or during a normal life cycle of if we didn't have the COVID problem. So we're talking about crisis management to its best. So the first thing you have to look at is you have certain bills you have to pay. You called them the non-discretionary costs. You got to pay your insurance. And one of the pressures are, there's still going to be some pressure on existing costs rising. We've been advised by the insurance agents that we expect director and officer liability insurance in Hawaii to go up 20 to 30% in 2021 because of all the claims that are filed in Hawaii. Hawaii has the largest rate of D&O claims of any state in the country. So believe me, there's going to be some pressure on current costs that will go up, which means maintenance fees theoretically would have to go up if you don't do something to try to counterbalance that. So where are these non-discretionary costs or costs that you may have the ability to move on? And there's 3 or 4, and I'll start with one and we can talk about that. The first would be your contributions to the reserve fund. You know, and there's 2 parts to that. There's your reserve fund balance, how much you have in the reserves. And number 2, how much you're contributing on a monthly basis to reserves. On the amount you have in the reserves, you, under the current statute, have the ability to borrow from your reserves for emergency circumstances. I think COVID meets that requirement. So that if you had a shortfall in your operating budget, you could say, we're going to fund that shortfall by hypothetically borrowing $100,000 from our reserve. I mean, I made up the numbers. The issue about that is if you did that, you have to pass a resolution, you have to disclose it. Under the statute, you have 3 years to replace it. And you would replace it by increasing reserve contributions in a future year when maybe things have stabilized better. So I think the first thing you have to know is that one of the sources of funds would be borrowing from your existing total reserve fund allowance.
What you're saying then basically is, let's say these insurance rates increase, and you're absolutely right. I've had experience where some of these insurance rates have increased drastically, not just the D&O policy, but the property insurance. The insurance industry in whole has paid out millions and billions of dollars of cash over these last few years, and they are forced essentially to increase these rates. So let's say that the operational expenditures increase by $100,000, or your anticipated expenditures increase by $100,000 for fiscal year 2021. So you're saying is to essentially take $100,000 from the reserve fund and essentially subsidize that portion of that the increase in maintenance fees in order to possibly avoid a maintenance fee increase. Is that what you're suggesting?
Yeah, there's 2 ways to approach it. If you had an immediate demand for cash because your insurance premium was due and you had no money, you could go to your reserve fund itself and borrow from that reserve fund and get the money you need to pay your bill, but then you'd have that obligation to repay it over 3 years. So you could do that. Number two, you could say if you're putting in hypothetically 10,000 a month into reserves right now, or 120,000 a year, and you need to cover some shortages because of delinquencies and or increased costs, you could say, oh, this year I'm only going to put $60,000 a year in and up those contributions in a future year to catch up. It gets you through this year or two by just reducing your reserve contributions. If you didn't have that immediate need for cash, your cash flow would allow you to do some reduced payments. And the key would be to put it in your budget reserve study and disclose what you did and what your plan is.
So in order really, I think in my mind, in order to really reduce the reserve contribution, in order to allocate more of that money to the operating expenditures, is it's likely you would have to prioritize your reserve projects. Reserve projects that you may have upcoming in 2021 may not be absolutely necessary to perform in 2021. So the way I see it, in order to reduce that reserve contribution, you may have to prioritize and readjust some of those projects that you have planned out in the near future in order to accomplish that. I see essentially, based on what I've seen, reserve contributions oftentimes, in my opinion, are on the low side, 17 to 20% of total operational expenditures. On the higher side, I'm seeing upward in the 30% range. So that's a large pot or a large nest egg or one single line item that potentially is what you're saying is could be slightly reduced for fiscal year 2021 to meet these other operational expenditures.
Right. So it's the way you make the budget work, because the combination of your, I'm going to call them operating costs, your maintenance fees, plus your reserve contributions, which is the total maintenance fee. You don't want to increase maintenance fees unless you absolutely have to this year, in my opinion, because I don't think we know what this is going to be, and all you do is make it worse in the sense that people can't pay the bills and you get foreclosures or they just give up and don't pay you at all instead of giving you something. So I think what you do is look at your reserve contributions and say, what can I do to defer some of those expenses? So if there's something you can wait a year on, maybe the exercise equipment, you don't replace it all right now. If you have a gym, for example, realizing that certain things that may get worse if you don't fix them have to be fixed. But I think I'd looking at my reserve fund as a pool of money available if necessary. My reserve contributions is something I can reduce in the short term, realizing I'll have to increase it more in the future, as ways to generate some additional cash flow to cover the delinquencies and any increases in operating costs you have this year.
Yeah, I think that's an important aspect that you touched on, is that you might temporarily reduce those reserve contributions, but ultimately in the long run, possible fiscal year 2022 or a future year, those funds will need to be paid back to that reserve kitty in order to meet your future capital expenditure needs.
Yeah, in technical terms, if you did accrual accounting, and not everybody does, some do cash accounting, if you have a $10,000 a month going to the reserves and you don't put it in, the balance sheet should say due to reserves because you have unfunded reserves, right? Mm-hmm. So you have to kind of put it in the budget reserve study, but there's a lot, more to that story.
Great. So we need to take a short break for a moment, Richard, and we'll be back to continue our discussion.
Aloha, I'm Krista Stadler, the host of Nonprofits Mean Business 2 on ThinkTech Hawaii. Nonprofits Mean Business 2 investigates the operational challenges and costs related to managing nonprofit organizations, while encouraging our viewers to find a nonprofit organization that you're passionate about in our community. We are streamed live on ThinkTech Hawaii bi-weekly at 12 p.m. on Thursdays. Thank you so much for watching our show. We look forward to seeing you then. Mahalo.
Great. Welcome back to Condo Insider. I'm here with Richard Emery. We have been discussing 2021 operating budget and reserve contributions. We have taken a brief look at mandatory expenditures versus discretionary expenditures. And also we have discussed the possibility of borrowing from the reserve fund in order to cover your your operating expenditures and or decreasing your reserve contribution in order to meet your other operational needs. That being said, Richard, I'd like to continue on with the discussion and briefly discuss the historically low interest rates that we're seeing right now. I know that there are many associations out there in the condo world that have had to borrow money to perform capital improvements to their association. Do you foresee any way to possibly reduce monthly expenditures by revisiting those and really giving a dive into those funds that they are tapped into or have to repay?
Well, certainly, borrowing is a common tool used by associations, and it may come to haunt us a little more in 2022 than 2021, because if I think condos have until May of 2021 to complete their life safety evaluation with the city and county. So if you're a 10-story building or higher, you may find yourself in the mandated fire sprinkler, which I don't think any condo I know has been saving money for this fire sprinkler. But in a general term, borrowing to meet immediate needs of cash and capital expenses is a common thing. And you can get up to a 15-year amortization and a 20-year amortization, but a 15-year term loan in today's market at the worst case for the larger numbers. But if you have a loan already and you're struggling, you might go to your bank and say, A, can we in 2021 pay interest only? Or B, look at the interest rate market and say, maybe we should refinance this with another bank because we're paying 3.5% or 4% now, and we think the current rates are 2.5% or 3%. I'm not sure what the exact rates are, but we know rates are depressed right now with respect. And sometimes you run into the problem that the original loan has this penalty in it. If you pay by another bank, prepay by another bank, there's a penalty in the loan itself that you have to kind of be aware of. But I think knowing borrowing is with 50% owner approval is a way to get cash and deal with deferred maintenance as well as cash needs. If you have a loan already, a couple things you can do. Number one, you can see if you need to go to interest only with your bank for a year, reduce the principal payments. You'll pay it later, pay interest on it. Or B, you want to go get a whole brand new loan and pay it off. And let's just say you have a small balance on your loan and you have a lot of money in your reserves. You might be better off taking the money from your reserves, paying it off, because you're only making 0.5% now or less on your reserve fund, paying it off and not having the 3%, and recategorizing that in your budget so that you've reduced that loan payment obligation altogether, reducing your cash flow need.
So I've been involved with a number of associations that do currently have a loan in place, and to speak to your point, a number of them do have relatively small balances, and their monthly payments oftentimes run in the $10,000 to $20,000 range per month. So just to clarify, so if the association has a healthy reserve fund balance and they could afford to, let's say, pay off a $200,000 or $300,000 loan balance, and therefore saving $10,000 to $20,000 per month on that loan debt obligation, do you find that that would be advisable at this time? Considering that, to your point, the interest rates being earned right now are lousy, so that might be a way to actually, one, reduce the monthly payment, but also save that 3.5%, 4% interest rate.
Absolutely, and I'm not going to say it's. My advice is they should consider, because every condo is going to be a little different on their financial circumstance.
Of course.
But the reality of it, it's an option to prepay the loan, so they don't have that cash flow requirement anymore, which helps offset increases in maintenance fees. B, they can go get a new loan if it's only got 3 or 4 years left on its term at these high payments. They could go get a new 10-year loan, pay it off, and then maybe have payments of $4,000 or $5,000 a month because they've stretched out longer because of the low interest rates, and they need to get the difference between the current monthly payments and a longer amortized monthly payment to help cover some of the deficit on that. And so I think, and if they certainly have a problem today, they don't have the money and they've got to fix something, otherwise it's going to cause safety problems. They have the right to go get a loan anyway, just to help cover it, because I don't think the owners are going to want a special assessment right now.
So do you have any experience, Richard, where an association may look at the reserve study and they bundle a number of projects essentially into one loan, therefore possibly reducing the reserve contribution due to the fact that those capital improvements are now funded by a 10 or 15-year loan, and therefore possibly reducing the actual financial obligation either in the reserve contribution and essentially the loan payment and the reserve contribution combined being less than what the original reserve contribution originally was, I guess what I'm trying to say. Have you ever had that experience?
Oh, all the time. Because think of it this way, if you have 3 or 4 major items coming up in the next 3 or 4 years, statistically, that puts great pressure on the amount of the reserve contribution. So if you said we're going to do some of those early in, let's say, 2021, and you bundled all these 3 or 4 items into a single year loan on a 10 or 15-year amortization, because they're all fixed new in 2021, it puts low statistical pressure on the reserve contribution. So oftentimes that loan payment is less than the existing reserve contributions because you've fixed them all new, long life to replace. You're paying for it over 10 years. Where under a reserve study, if they were doing 3 or 4 years, it's forcing you to collect the money over 3 or 4 years. So it often works out very strongly to the owner's advantage to look like 5 years out, take care of it all now under a single loan. And these loans aren't all P&I right off the bat. They usually start out interest only, and it's usually a max amount. You can borrow up to $3 million or whatever the number is. And so as you get the actual bids and go through that cycle, you end up only borrowing and paying interest on what you need. But a more global plan would be to look out maybe 5 years and take a look at any major components, because the probability is pretty good it would reduce your monthly cash flow needs.
Great. Are there any other considerations that you think association should think about or investigate in regards to other items that are related to COVID-19? For example, as you're aware, we're on a lockdown again, and owners or residents of Hawaii are essentially forced to stay at home, work from home, leave their unit as much as possible. Are there any other considerations in regards to possibly what projects should or should not be done during this period of time, considering the circumstances that we're in right now?
Well, I'm only giving you my view. I think you want to be as conservative as possible. And the things you can see create safety problems and or would continue to deteriorate, so the costs in the future would be higher because you didn't fix it now. You kind of have to do those. But there are going to be things like hallway carpeting, maybe replacing some exercise equipment or fixtures, maybe an upgrade to your entry landscaping, things you want to do, but just because, because I know that I'm one of my little side jobs is I'm a bankruptcy trustee, and I teach crisis management. And what I try to say to everybody is preserve cash, save cash. You don't know what tomorrow is going to bring. How many more shutdowns are we going to have? What else is going to happen in the process? So you want to be very, very conservative and do the need to project versus the ones you have some flexibility on.
So you don't think it would be advantageous possibly? Right now, obviously, the pool use is very limited. The gym use is very limited. So in my mind now, if the funds are available, obviously, and the association is not struggling financially, I would almost be of the perspective that now may be a good time to renovate the pool or renovate the gym, just due to the fact that usage is very low right now, subject to obviously making sure that they're in a financially strong position. These, going back to the kind of the mandatory discretionary thing, those items like that are more of a discretionary item. But I'm almost of the opinion if they're in a strong financial position, that now might be an opportune time to perform some of these renovations if they are going to occur in the near future.
Well, I think certain times there are. It's a little bit, like we said, every project's different. Because if everybody's home, you might have higher pool use, for example, or higher use of the gym because we're on a lockdown, stay-at-home order right now. So it's hard to measure, but we certainly see that if there are projects you can do now because you have the funds and you have financial stability and do them now, it's a good time to look at it.
We have about 2 minutes left here, Richard. Any other last suggestions in regards to items that the association board members may take a look at to help minimize the maintenance fee increase, keep the maintenance fee increase at the same or possibly lower the increase? Any last minute words of advice?
No, I think that the key is look at all your resources, which is going to be cash in the bank, reserves or otherwise, ability to borrow, get a realistic estimate on what your operating costs are going to be with the new numbers for insurance, et cetera. Because, like you said earlier on insurance, with all those fires in California, they'll affect our property rates here. That's all part of reinsurance. But the reality of it is, and I would say just a good year to take a really good look at your reserve study, because that's going to have a major impact on your budget. And that's probably one of the best areas to look at if you have the ability to amend it to help you get through this period for the next couple of years.
I agree. Again, that's just such a huge operating line item in most budgets. Again, I'm seeing it's between 18 and 30% of the operating budget. So I think that is one line item or area that you could really dive into to find some financial relief during these trying times, with keeping in mind that those funds will need to be repaid or increased in the future. Richard, thank you for your time. I appreciate you coming on today and joining us on Condo Insider. Viewers, please join us next week for our next episode of Condo Insider. Aloha and thank you.